Hi, everyone. Thank you for joining me today for the YX Insights webinar. Today is September the 10th, and we're recording this after the market close. All right, so a lot of content to go through today. Because there is a presidential debate going on later today, we're going to start with the implication of the both Trump and Harris getting elected for Bitcoin. Then we're going to go through the non-farm payrolls, CPI data, as well as analysis of the past rate cuts, the impact on the stock market. I've not done a SP 500 analysis on the webinar before, so we're going to start today. And I'm going to cover the usual charts for TLT, Bitcoin, gold, silver, and Magnificent Seven. All right. So to start with, so Bitcoin has had a pretty turbulent month since the August 5th crash. We were very hopeful it could move up to start moving towards the medium-term target of 92K, but it has just been really, really choppy. 3 waves up, 3 waves down, and I think it has wrong-footed a lot of people. So right now it's around 57K, which is where we entered the trade. It's been a bit of a yo-yo, and I just want to kind of put a quick analysis on what happened in the past couple of weeks. I think the main driver here is institutions selling out of the ETFs. As you can see, this is the spot Bitcoin ETF flows in Bitcoin. Since basically August, we have essentially had really chunky outflows every single week. And I think last week had a straight week of selling as well as the week before. So in terms of flow-wise, it's pretty bad. So the US ETFs account for about 3% of the Bitcoin supply, but obviously not a big chunk of Bitcoin is actually in Wales wallets. They don't move as much. So the ETF flows do have an outsized impact more recently. Just moving on to tonight's debate. So recently I read the headline, Bernstein predicts a Bitcoin price of 80 to 90K if Trump wins the presidential race, or 30 to 40K if Harris is elected. I think the rationale is that Trump will be heavily favoring deregulation for the crypto industry. I think his family members are running some crypto offering as well. And he's openly said that the United States will be the crypto capital of the planet. So that is a very strong pro-Bitcoin statement. I think the market has insufficiently priced in the deregulatory tailwind. So if he does, I kind of do agree that if he does get elected, there is a lot of Bitcoin upside from the regulatory perspective. And I will touch on this in a second, but I think broadly speaking, in terms of human history, laws are made to protect the rich from the powerful. So I think up until this year, the rich didn't really get into Bitcoin that much. We had a banking head saying Bitcoin is a Ponzi scheme, a scam, etc., etc. But this year, the SEC greenlit the ETFs for Bitcoin and Ethereum. So the rich now have joined. So I think the regulatory path would be far easier going forward. And I actually think that will be held true no matter who gets elected in the next cycle. So Harris doesn't directly accept Bitcoin herself, but the Future Forward PAC, which is a huge resource for the Democrat Party, accepts Bitcoin or crypto donations on Coinbase. And that's been confirmed by Coinbase themselves, as well as the spokesperson from Future Forward. So I think 30-40K if Harris elected, the rationale was that from this analyst is that she's been very quiet about crypto industry and she's meant to be all for green energy. But I think once the floodgates open, it's really hard to reverse. So yes, marginally Trump should be better, but I don't think Harris being elected is that bearish either. Just looking at the US government holdings, currently the US government holds 200,000 Bitcoins worth $12 billion. That is about a third of the ETF holding, all ETF holdings combined in the US. So all of the ETFs hold just shy of 600,000 Bitcoins. So the US government holds a third in comparison. So if Trump gets elected, right, the first thing he can do is just to keep the money there, keep the Bitcoin there without selling. The US sold a little bit, but they haven't really moved in the past year or past 18 months, but they haven't really moved that aggressively, unlike Germany did. So the first thing they can do is just hold on to this and not rush into selling anything. And if they want to build Bitcoin into broader reserve as a reserve currency one day, they can build on top of this, right? And we've also seen the headline, Michael Saylor saying yesterday that Bitcoin is to reach 13 million by 2045, which is 20 years away. I think the first time he mentioned this was a few weeks ago, since we started the service, and I actually have got his spreadsheet model to see where he got this 13 million from. You should be pleased to see the depth of analysis we go through here. So essentially, there are two parts to the model. So this is the front page. The front page is only focusing on Bitcoin, and the second page focuses on all the other assets. His argument essentially is that the base case scenario, he sees that Bitcoin so far has risen 50% year on year, and is going to continue to do so. But if you assume that each year, because of the snowball effect, the base effect, the growth rate will be reduced by 2.5%. So, it grows 50% 1 year, 47.5%, 45% the year after, et cetera, and stabilize around 20%, which is double the long-term stock market return. Then, but in 20 years' time, Bitcoin would be worth $13 million, right? And in the bear case, if you assume from next year onwards, it's going to grow at 25% and then decreases by half a percentage point each year in terms of growth rate and stabilize around 18%, then by 2045, it should be worth $3 million. There's two problems I have with his argument. And this is the same problem that we have with all the other charts, like the power law charts. Essentially, this assumption is just assumption saying if the price grows at 50% a year or 25% a year, then it will reach that level. It's just a math, right? It's just compounding effect. But there's no real, he doesn't articulate where the real basis of this growth rate is from. So, well, supply side, we know is fixed, which won't grow, which will grow, but it will top out. But on the demand side, it's far from certain that we'll see this growth rate, or even 25% in the next 25 years. So he doesn't really offer a reason why. In the interview, he's pointed out, we've done incredibly well owning leveraged our balance sheet and own a chunk of Bitcoins, and we've outperformed S&P 500, making something like 800% in the past 5 years. But the whole argument is centered around the past performance predicts the future. And if you actually look at what this means, so the market cap. So today, Bitcoin is $1 trillion in terms of market cap, right? It's slightly smaller than silver. Gold is 16 trillion. What it's predicting in the base case scenario is a 280x in 20 years. 280x, if you look at past 10 years, that's a very feasible number based on the past performance. Is it going to 280x in the next 20 years? I don't know. But for comparison, he's suggesting that gold will 3x from 16 trillion today to something like 45 trillion. Equities were 8x from 115 trillion to 800 trillion. Real estate were 5x, 330 trillion to something like 1,000, what is that? 1,005 trillion. And bonds were triple from 300 trillion to 900 trillion. So all the other assumptions, are within single digits. All the other asset classes, except for Bitcoin, is going to 280 times. So I think it's just treat this model with a pinch of salt. And in his broader analysis, he suggested that inflation should be something like 6% between now and 2045, which is way above our expectation, essentially. If you adjust inflation back down to something like 2%, 3%, which is the Fed's target, then all the other assets will really just like double or triple maybe, rather than 5 to 8x. So that's where he comes from. And I just want to compare Bitcoin with gold for a moment in real life. So the US holds reserves in gold and foreign currencies. And this is because of historical reasons. After the Second World War, the US was seen as a superior economy. 44 countries signed up to have a fixed foreign exchange rate with the US, which is a US dollar, which is backed by gold, right? $35 was backed by 1 ounce of gold. And in 1971, what happened was that the US announced that suspended the convertibility between gold and dollar. So essentially, dollar became a fiat currency, not really backed by anything. And slowly, all the other countries' foreign exchange rates became floating. But the US still held onto its gold, so 8,000 tons. And as a percentage of the US reserves, it actually grew because the gold price grew from something like 50% to now 70%. Right. So that is worth north of $600 billion. I showed you the chart earlier. Currently, the US holds $12 billion worth of Bitcoin. To match the same level of reserve in gold, the US has to buy a lot. And in fact, the US would have to buy something like 60% of the whole supply because the Bitcoin market cap is 1 trillion. So there is still a long way to go, essentially, before, even if the US government adopts Bitcoin as a reserve, it's still a long way to go to match gold. And as you can see here, the US, Germany, IMF, Italy, France are the top gold holders. Russia, China, and Turkey have been buying more aggressively in the recent years. So gold is still very favorable. No one buys silver as a part of the reserve, which is why silver's market cap is so small. And no one's bought Bitcoin yet. I can't remember if Russia said they would want to do that. But if they do, it's a huge tailwind. It legitimizes Bitcoin completely in the eyes of the establishment, essentially. But we are still quite a long way from matching the gold level. So there's another thing to think about when you are reading Michael Saylor's prediction of 13 million dollar per coin and therefore 200 trillion market cap. It's going to be several times or 10 times the size of gold. Is that realistic? I mean, it could happen. A lot of things could happen. We could have a World War III and all the countries start rushing to buy Bitcoin, etc. But it's not the base case for me. And just to touch on, we're going to go do a bigger seminar on this later in the month. But I just wanted to talk about like fiat versus gold and Bitcoin, and in terms of the value of money. So what makes money money? There's a lot of properties that makes humans, as a society, very selective on what we treat as money. We've used to. So first, money is a unit account. And so if I want to buy something, it has to be, I know what the price of a burger is versus the price of a watch, for example. But also, like the money has to be easily divisible. So $100 can easily divide into $1 notes or whatever, $10. I would say all of this probably match it. Gold historically fulfilled this promise. So did silver for quick and easy transactions. Bitcoin, you can divide that into Satoshi. Secondly, fungibility. So $1 should be worth $1. 10 $10 bills should be the same thing as one $100 bill, right? Money is fungible, so there shouldn't be any difference between one unit of dollar versus another. And same as gold, right? 1 ounce of gold is an ounce of gold. You can melt it, you can reshape it, but it's still gold. And Bitcoin too. So Bitcoin is fungible. One Bitcoin is the same as another Bitcoin. You can argue about portability. Money is easily carried around to pay for services. I think all three can do that. There's no problem. Where fiat stands out is here, in this circle here, acceptability. Is US dollar. You can use that US dollar to buy petrol in the Middle East. And that is a huge advantage. You can use a dollar to go into a store and buy something, McDonald's. You can't really do that with gold. You can do that with Bitcoin at some places, but it's slow, right? And some countries have experimented this. And you can't use this Bitcoin in most places, although that acceptability is expanding. I think there's still a long way to go, but fiat definitely beats gold and Bitcoin in this area. Secondly is stability, which is different to store of value. So I'm not talking about inflation here. Well, it's sort of linked, but in G10 countries, your foreign exchange rate doesn't change drastically. Sterling dollar, euro dollar, they move like 1% on a big day, right? So it's fairly stable to trade, and even when we're talking about inflation, the Fed is trying to manage inflation to 2% a year. So it's trying to target the price stability. This is a big issue for Fed if inflation gets out of hand. So on a day-to-day basis, the fiat money in G10 countries, advanced economy, is still pretty good. But when you get to some places like Venezuela, Turkey, Egypt, then their fiat is pretty bad because of hyperinflation. The price of goods based on the fiat changes every few hours, and essentially the money is worthless. Whereas gold and Bitcoin in those countries are particularly useful. Cognizability, whether it's recognizable, as in the old days, people would carry their jewelry around. The one thing about cognizability is that it's because money is used to signal. So if you think about how we make income, right? We provide value to employer, customer, whatever, and we get a unit of credit, essentially, a unit of social credit I can use later on to interact with strangers and buy goods with people I've never met before, right? So in the old days, if you carry a lot of gold and jewelry, it's signaled that in the past you probably have provided good value to the society or to your tribe, whatever, before, and therefore you're creditworthy, right? And it provides you with higher status. So having that cognizability is pretty important, and whether that's your bank account, billionaire status, whether you're wearing gold around your neck, or if you're having laser eyes on your Twitter profile or NFTs to show that you've bought Bitcoin, these are all equivalent to signaling your status, and also the fiat and the gold and Bitcoin themselves are recognized by the wider society. So I think that's no problem. Durability. This is really talking about gold. You can't easily destruct it. You bury it in the ground. You can still dig it up, and it's still good. It doesn't change after 1,000 years. It doesn't make compounding reactions with other elements. Bitcoin, as long as the network exists, each block is immutable and is recognized across all ledgers. If people really want to create a new type of Bitcoin out of the network, they have to do a hard fork, and that new Bitcoin would actually be different to the original Bitcoin. And people have done that before. So limited supply. So this is the part where people is more favorable for gold and Bitcoin. So in terms of, if you think about the total amount of supply, stock in existence, an amount of gold above the ground, which is something like 100,000 tons, and how many Bitcoin? We have 20 million Bitcoins now. It's really hard to replicate that stock very fast. And this is extremely important because you can only dig up so much gold from the ground each year, so it takes something like 65 years to replicate the stock of gold. And in terms of Bitcoin, after every halving, it gets more difficult, and there's a hard cap on how many Bitcoins you can do. So people can't. And this is really important because imagine if I was living in an island and I used something like stones as a currency, or iron, as a metal that is really easily producible. A stranger with superior technology can just replicate that product and flood my money market, flood my money supply, and my wealth will be worthless, and the strangers will become the number one richest person on the island, right? People can't do that with gold and Bitcoin. And up until probably financial crisis, the central banks have been fairly reserved in printing money in terms of QE. Since financial crisis, and especially since COVID, the Fiat, the central banks kind of just really love printing money. And that is a huge argument against fiat dollar and in favor of gold and Bitcoin. And finally, store of value. I would say in the longer term, gold has always caught up with the money supply. And even though sometimes it goes through a decade of bear markets. So if you stretch long enough, big gold was recognized 100 years ago, is still recognized today. And a house today is probably, in terms of gold value, is probably similar to a house 20 years ago. You can't say that about dollar, right? You can't say that about the fiat currency. And in terms of Bitcoin, we had a very short history, only just around 10 years. And obviously you can say, oh yeah, it went from $1 to $60,000, therefore it's a store of value. The thing is, this history is so short in terms of credibility. In my store value, it just needs more test of time, right? And if it fluctuates, if the volatility is so big, it goes up and down 60% in any given year, it's probably not a good store value of people who are trying to hold it. And psychologically, it can be very testing. So I think Bitcoin needs more time of test. And I think Bitcoin can benefit from lower volatility. But because when volatility reduces, it also means there's going to be less potential upside for Bitcoin. So it's a trade-off of what you want. So generally, when you want to store value, you're not really looking to 10x your investment. You're trying to just match inflation or do better. So I think that's the contradiction right now with Bitcoin. And but in terms of those two factors, definitely better than fiat. We're going to cover the charts in the second part of the webinar. So if anyone has questions right now about Bitcoin, please feel free to unmute yourself and ask. Otherwise, we can move on to non-farm payrolls. All right. Okay. Thank you. So Friday's non-farm payrolls printed 140K new jobs added. So that is better than the previous 2 months. And unemployment rate also ticked down from 4.3 to 4.2%. The market, so the bond market actually, the yields actually went up straight after this report, briefly. And then steadily, the yields went lower during the day. But just to recap on what we did last week, last week we drew the correlation or the correlation between unemployment rate and it changes in initial claims. And we said this relationship holds most of the time, but there are some months where it doesn't. It did hold this month. So lower initial claims led to lower unemployment rate. But the market deemed it not good enough. And the reason is that, first, this 140K figure was below the consensus of 160K, so 20K below. But also the previous 2 months, July and June, got revised down by a total of 80K, right? So if you actually think about the miss of estimate here and the downward revision here, so the non-farm payroll together, the 3 months, missed undershot by 100K, which is a big number. And if you think about the reaction market had in July after seeing 114K, it suddenly makes sense that, okay, it's even worse than what people thought, right? So essentially, we had a risk-off period on Friday and well, all of last week, but also on Friday. Most of the jobs added, a lot of the jobs added came from healthcare, which was also a big factor before, as well as hospitality and hospitality and leisure, but that was a decrease from last month as well. And hourly earnings ticked up by 0.4% month on month. So the year-on-year rate is 3.8. So this report is really mixed because we had a lower unemployment rate, but worse net jobs added and a higher hourly earnings. And you can see that hourly earnings on a 3-month annualized growth basis has ticked up from beginning of April. And this basically puts upward pressure on CPI, which is something that the Fed is trying to contain at the moment. We got a classic risk-off scenario in the last week and after non-farm. So when I say risk-off, it means equities sell off, but also bond yields go down. And they go down because investors rotating to buying safer assets like US treasuries, and also the market's pricing in more Fed cuts in the coming month. So after non-farm, yields up and then down, and then climbed back up again yesterday and went down midday. So I think we're still in this risk-off regime at the moment. We really need to climb out of it to see equities going again. I can explain about this blue box in the second half of the video when we do the charting. But at the moment, the market is still slightly bearish. So one of the members asked last week whether it was because of the holiday seasonality, people coming back from Labor Day, trying to manage risk, getting rid of positions, etc. So I did analysis on the holiday. I love the type of holiday seasonality of SPY for the past 30 years. Essentially, there's not that much effect. It's pretty much in line with broader monthly seasonality. You know, there's the Martin Luther King's Day and President Day. These are, you know, end of Jan or February. January equities are quite weak. Labor Day, September is a quite weak month, and October is a good month usually, and Christmas is, you know, the Santa Claus rally. So I think there's not that much to say say about this. Volatility does pick up. The range gets, so this is the max and the best and the worst days. The volatility kind of shrinks in the summer. People leaving the desk. There's not much trading going on, and then volume picks up again after Labor Day, which is true actually. So not too much to comment on here, but it's just to neatly round off what we said last week. Looking ahead to tomorrow. So tomorrow we have CPI. For the past 4 months, CPI essentially either undershot or came in line with expectations. So it's cooling in the Fed's favor, making the rate cut jobs much easier. we forecast a 0.2% month-on-month increase for both the headline CPI and core CPI. The data is missing the forecast for core CPI in terms of year-on-year, so I did this manually, but it's unadjusted in some seasonality. So tomorrow's number, even if it comes in line, could be different because of the seasonality adjustment they do. So we expect cooling from a cool down in terms of year-on-year CPI. And to put that into the broad scheme of things, we should see further cooling. This is the estimate I used just now, coming into August. But the thing is, market is already expecting this. And the way the market is reacting right now in terms of risk off makes me feel like they are they're very richly pricing in Fed cuts. And if CPI actually comes higher than expected, the market could be quite wrong-footed in terms of the rate cut expectation. So on the margin, I think the base case scenario is already very benign. It's really hard to be more dovish than this. And in terms of 3-month annualized rates, I only have the headline and core CPI, essentially flat from the before, and headline picks up. So 1.2 is still within 2%. And actually, it's not a bad thing, because if you go further down, it's deflation. So within 0 and 2%, it's not, I think there's nothing to see here, basically. And getting into the more detailed breakdown of the components, last month there are basically a few main drivers of the CPI print. First is energy. Energy explains a bulk of why CPI undershot in the past few months. Minus 2% month on month again, and then flat in July. So that contributed to 0.14 decrease in the CPI number. Shelter, again, shelter is a big component. It actually explains half of the rise of the CPI levels. It was hotter last month, and actually that was against my expectation. I expected it to cool down. It actually ticked up. So this is something we need to watch. Motor vehicle insurance, it ticked hotter as well, which was a bit unexpected. But overall, last month report was in line with expectations. So we just need to watch those elements again this month. I'm going to go through all the necessary components before tomorrow's data release to have a sense of what we should expect. First, I think oil will drag down CPI again. It's essentially collapsing from the high of $85 2 months ago. And it is at this very crucial medium-term support of just below $70. Right, OPEC is really not happy to see this, and I think it's basically because there's a lack of demand. Seasonally, probably September, like summer month, probably not that strong. But I think I think at the moment, because of the recessionary concerns, risk-off concerns, oil demand is not that high, and you can see this. Recessionary concern in the 5-year break-even inflation rate, and this is deduced from the inflation-adjusted bond yields. It's actually below 2% now. So before August, it was above 2%. Now we are below 2%. So the market is expecting softer CPI or softer inflation in the next 5 years. So this just means for the next 5 years, market expects an average of 1.88% of inflation, which is incredible, given where we come from. Supply chain bottlenecks, this mostly affects goods. So, things like shipping out of transportation, out of Asia to Europe, Asia to US, etc. This is not absolute units. This is done from the standard deviation of historical averages. It's ticking up, but it came from a very low base of nearly minus 1.5 standard deviation below average. Now it's around average, so I'm not too concerned. If it gets to above 1.5 standard deviation, or even above 2, like over here in May, I would be much more concerned. So above 2%, above 2 standard deviation means the top 2.5% of the time, which is a small occurrence. Car insurance. So using insurance file data, in August, car insurance rose by half percentage point month on month versus 1.1% in July. So that suggests that the car insurance factor on the monthly should also slow down. And hopefully that would help CPI lower, core CPI lower. Rental, 0.1% increase month on month using Redfin data versus negative growth in July. So this is why I was surprised. We saw a 0.4% downward adjustment in July, but hotter CPI reading. So this makes me think, like, if we think about relative basis, the housing market is hotter again, and therefore the core CPI in the shelter components can come hotter again this month. On the balance, that's why the market is expecting a fairly benign CPI report, but shelter can run through the market. If out of all these elements, shelter is the one that's with the biggest risk factor of overshooting. So in terms of core CPI, again, wage growth, another element. Historically, higher wage growth puts pressure on higher CPI. This is because businesses can want to pass on their labor costs into the price of products and services. So wage growth was hot in August. That again could put upward pressure on services CPI. So shelter and wage growth essentially could run for the market tomorrow. Same exercise we did last month. Previous 4 months, equities went higher into the middle of the month, into the CPI. CPI numbers were pretty good, as in they cooled down, and the equities rallied for a few days and then start correcting or consolidating. We saw the same pattern in August. It started flatlining here after 4 sessions. I did say before this print that if we get a rally after CPI into the Tuesday, we can take some risk off the table, and I think that strategy would have worked. Tactic would have worked pretty well between there and this week. The market was not that great, but now the pattern's reversed. Going into CPI now, we are having a very weak pattern. Essentially, investors trying to front run seasonality. Everyone knows September's weak. Why don't you sell at the beginning of September than wait? So it's really hard to say where it's going to go now. Seasonally, this week into the FOMC is benign. Benign meaning equities should bounce a little bit between here and there. But it's much harder to read now because we've priced in so much pessimism. And I think yields have come down a lot going to CPI. We might get a bounce after tomorrow. So I think the equities reaction is far from certain. But if we get a rally and we're long still, let's say we still have long positions, I really don't mind taking profit going into next Tuesday. I think that would be a good tactic to have. I think from this onwards into end of October could be a very, very tough period for stocks. It's not going to get that much easier from here. So before tomorrow, we have the FOMC pricing for the next year. The futures market is a bit messy around now, so it's not really in 25 or 50 basis point. All of them are in not so round numbers, 30 basis point, 40 basis point. All this means is 30 basis point is we're definitely going to do 25 basis point cut with 5 basis point additionally pricing, meaning 20% chance of a 50 basis point cut. Over here, it means 25%, 25 basis point definitely priced in, additional 15 basis point also priced in, meaning 60% chance of a 50 basis point cut, right? Because the Fed cuts in 25 basis point increments. What this table is showing between between September and November, we're definitely going to have one of the meetings that cuts 50 basis point. We don't know. So the market thinks it's probably the November one. It depends on where the CPI comes in. It could be the September one if the CPI significantly undershoots. And also the December and January could see 50 basis point cuts each, which is also very aggressive. I think Citibank says they expect 150 basis point cuts in those three meetings together, all right? So definitely very aggressive. In my opinion, too aggressive given what we know. GDP is still in great shape, 3% in Q2. And non-farm payroll unemployment rate hasn't really come that much, it's improved from the month before. The headline is not great, but we're not in a position where we're seeing no job added or net loss of jobs yet. That would be really recessionary warning, right? So I think given what I know about the Fed and the FOMC members and the fact that they only pinned down one cut for the year in June, it's really hard for them psychologically to say we are wrong so much that we're going to cut 125 basis points by the year end. It just makes all of them look extremely silly, right? I think they'll go from one cut to 3 cuts, but they are unlikely to move to 5 cuts in the space of 3 months. So I think Powell will push back on this next in the FOMC, and we'll cover that. We have a webinar before the FOMC, so we're going to talk more about what we should expect, his language, etc. And we had this chart last week, but I want to revisit because I think it's worth revisiting. What does equities do? It's really unfortunate that the first cut in this cycle starts in September, which is a weak month already. If it starts something like March or even May, it might not be as bad, or October, it might not be as bad. But we have a weak September, and then equities typically underperform in the first 30 days, right? So the median average. And you can see this is the worst performance, which is COVID, versus the best performance, right? At best, you're getting slightly flattish behavior. At worst, you're getting minus 20%. It's not really a good bet to be long equities in that period, right? But just drilling down a little bit more than last week. So these are the past 4 recessions we had since 1990. The reason we go from 1990 because SPY and QQQ start in 1996, 1999. So we have limited history for the ETFs. But if you look at the past 4 recessions, so 1990 was a oil price shock, the Middle Eastern War, and GDP fell by 3.6% in Q4, and employment rate went up to 7.7%. This doesn't happen within 1 month or so. This happened within the space of a year, 18 months, right? And we had dot-com bubble in 2000. Again, GDP fell by 1.6%, which is actually not that bad given the size of the stock market falling. Employment rate from 3.8 to 6.3. And actually, that's a little bit quite similar to where we are today in terms of the stock market being driven by the AI the wave of AI application, AI hype, and Magnificent Seven stocks. Unemployment rate starting in the mid 3s, moving to low 4s now. And then we had the financial crisis, which is the housing market driven, and that's GDP fell by 8.5%. It was extremely painful. Employment rate shot up to nearly 10% in the next 2 years. And then we had the COVID, and obviously the COVID recession was actually really short because the Fed acted really swiftly, and the fiscal policy was extremely loose. So yes, we had minus 28% GDP, but it rebounded straight away in the second half of 2020. So just going back, so the reason we look at this is that how equities react really depends on the macro environment we're in, whether we have a recession or not. And what we're trying to do is, right now, yes, we don't have a recession. Is there a chance that a recession is underway? And therefore, if it is underway, we could see worse equity performance. The argument for recession being underway is, if you look at the past 4 recessions, actually, if you look at the past 2, what really happened is that the interest rate, so the Fed funds rate, went above PCE, the headline inflation that the Fed uses to target for the inflation target. So we had real positive interest rate in this period. A real positive interest rate just means the nominal interest rate is above inflation. And that staying here this long has triggered, had made mortgages more unaffordable and some prime sector defaulting, et cetera, and it led to this credit crisis. And again, in 2019, we had Fed funds rate above inflation as well, right? Staying here, and it wasn't sustainable anymore. The Fed started cutting, but we had a COVID-induced recession anyway. But without COVID, we were going to have a recession as well. It just COVID really exacerbated it. So the case for now is that we have a real interest rate, right? Headline inflation is 0.6% in PCE, and we have a Fed funds rate of 5.33. So 2.5 to 3% real interest rate. And we could see a repeat of this period and that period. Obviously the argument against that, before 2000, we had real interest rate for a long time. It was always the case that Fed funds was above inflation, et cetera, et cetera. So it's undecided yet. The second argument for recession is that the New York yield curve as a leading indicator is showing more than 50% chance of a recession because the 3-month bill rate is inverted with the 10-year bond rate. So we can use 2-year versus 10-year, which is a faster, earlier indicator, or the 3-month versus 10-year. We can look at both. But every time we had this yield curve normalizing, so going from inverted to normal, we had a recession pretty much in the past 30 years. So we are having a normalization period again, and the chances are we might have a recession. We just don't see it, how it's going to happen, but according to this indicator, is coming. So does the sum rule of unemployment rate, where the unemployment rate is 0.5% above the 12-month low. So looking at the yield curve inversion, the 10-year versus 2-year, the 2-year versus 10-year crossed the parity. It first crossed parity last month, crossed again properly, now it's positive. So it feels like recession could be underway. But the 3-month versus 10-year is still negative by 110 basis points, 120 basis points. So if you look at this chart, it doesn't happen straight away, right? This is a 3-month versus 10-year, and it normalizes after a little bit, and we get a recession, and we still haven't normalized yet. And this hasn't normalized because the Fed hasn't cut rates yet, right? So the 3-month is basically the Fed close to the Fed funds rate, which is 5%. And we haven't cut rates. So mathematically, this can't be above the 10-year bond rate. And just to put everything together, the SP 500, the GDP, recession, and the yield curve, just looking back from 1990. So what we really need to watch out is, first, okay, the yield curve is now crossing back this 0% mark. How long does it lead the actual sell-off in equities? If you look at 1989, you can say it led, this is the monthly chart, right? So it led by nearly a year before we had a sell-off. and the GDP fallen below zero, right? And in 1998, which was one of the Fed cuts, it sort of straight away, but it bounced back straight away as well. And we didn't actually get a recession in that time. And it could be our scenario today. 2000, when the yield curve normalized, essentially the Fed cut too late. The sell-off already happened. And GDP went negative straight away. 2007, it crossed once, false signal. There was a little sell-off, but not much. And it crossed again. And there was another 6 to 8 month lead until this big sell-off. But that was really painful. And the GDP obviously went down significantly. COVID, 2019 trade war touched the inversion and crossed back, a 6 month lead. So we had a rally into the new year and the sell-off from March after COVID outbreak. And here we are now. So it's crossing here. So it feels like if we sell off now, we could be in this territory or this territory. It might not be a big problem because the market can rebound straight away. But if we have a serious recessionary concern, we should have something like 6 months as a leading indicator, right? We wait for the 3 month, 10-year yield curve to cross first, and then GDP to go below zero. I think Q3 is tracking on 2% growth. Still don't have to worry there, but maybe Q4 or Q1 next year could come softer. But it feels like we have time. We still have 6 months time. And over here, we'll go through the chart later. I've marked here. We could have a rally into the new year after this period of first cut, bearishness, etc. And then we get a big drop next year. So that is actually my base expectation looking at what we've worked and the whole macro picture. And then just to round this off, really, so the markets within the 6 months, so first 30 days is a write-off. Don't bother, right? Just play golf or something. Don't look at the charts. Or maybe you can start buying after day 30 or something. But the markets start bouncing back and actually taking off in all those years where there wasn't a recession, 1998, which I showed you in the chart earlier, 1995. And COVID was exceptional, but we had a really bad dip. So this doesn't really, we don't really want this anyway. And in 2019, which is the trade war. And then in all the other years, 2007, 2001 dot-com bubble, and there is one more, 1990, which is the Gulf War. We had really bad sell-offs for 6 months. So it's really about, I think we are in this scenario, or we have some time before we actually enter a recession. So if anyone has questions at this point, please let me know. I think these are all the slides done, and I can move on to the live charts after this. All right, perfect. And I really encourage you. So just before I get onto the charts, I just want to remind everyone that I've really spent a lot of time on the spreadsheet work that everyone has access to in terms of correlation matrices, as well as the ETF flows, seasonality, and trade setups. And also you can write your request in one of the tabs. You can write your request and have a look. If it is compatible with what we offer in the service, I can just do it straight away. There's no question. And obviously I can't accommodate everything, but I will explain why if I can't. But please take your time. And I update the ETF flows every day and the Fed funds rates every day before the market opens. So yes, so please use that resource. I think it really paints a lot of market color. So this chart is new. I just want to show you what I've done with SP 500. If you're familiar with my work, you know that I really like to look at things holistically, look at the whole history of something, instead of just choosing an arbitrary point to say, okay, like this is wave one, etc. So looking at SP 500, we've got data back to 100 years ago. The stock market crash in Great Depression was a cycle, wave 1 and 2. and that was a extremely painful drop. And actually, then we had a smaller degree 1-2 in the Second World War, and into the 1987 crash, wave 3 and 4, and the dot-com bubble was the cycle wave 3. And then between the dot-com and 2008, I actually think this is a 3 and wave 4, and it's expanded flat. Expanded flat just means the wave B is above the prior high slightly, and wave C is below the prior wave A low. And wave 5 really began after the financial crisis. And I think it's since the financial crisis, everything changed because of quantitative easing. The central bank really discovered their ability to print money, right? And Bitcoin was invented around that time. And now and it feels like at times they've been abusing it. And every time they want to taper, the market holds them hostage and have a tantrum. So the reaction function really has changed since 2008. Things also have changed because the regulations for banking system has tightened significantly. So theoretically, banks are safer than before. But as we saw, the regional banks probably not so much. It's the big banks that are being regulated. And in this cycle wave 5, we had 1 and 2 in 2011, and coincidentally, I think gold peaked around this time. And actually, I think the 2021 sell-off was the wave 3 and 4. I will show you an alternative count I've seen, but this is my count right now. And to me, wave 5 should finish just below 7,000, the cycle wave 5. It doesn't mean we are not going to have correction sell-offs in between. It just means this is when I expect the absolute top before we have the Great Depression era type of sell-off. And coincidentally, this looks like 100 years from to the Great Depression. So here, just to dive in a little bit deeper into the details, 1 week chart. So here we have wave 1 and 2, and projected at the wave 2 low. And I think the wave 3 was at 2 extension of wave 1, and is a fairly steep pullback to 1.618 extension. And because what this is and where this is, 3 and 4 are, I expect 5 to be 7,000. So 2 fib levels above the wave 3 high. And the thing is, if you think the top is in already, it's a really shallow wave 5. It's a really small wave 5 compared to where this run has been. And that is sort of my problem with the bears at the moment. It doesn't mean we're not going to have a correction, etc. But I think the longer term cycle top still has room. The alternative count, and I want to show you the alternative count, is this 1, 2 here, and then the COVID being 3 and 4, and potentially wave 5 here. I'm going to mark it in red to show its alternative, plus a question mark. Right, so that is the worry. And if you look at the fib levels here, so the COVID level was just below 2, and wave 4 low here, and naturally you get wave 5 top where we are today. I think this is too shy of the wider I think this is too short, and the reason is, and this is one of the reasons why I look at the whole picture of the cycle tops. If we look at wave 1 at the from the wave 2 low, the length of wave 1 from wave 2 low, and where wave three is, which everyone can agree was the dot-com, and wave four being the financial crisis. Wave five should be, so the dot-com bubble was 2.38 extension. Wave five should really be somewhere over here rather than somewhere over here, right? So if you look at, yeah, so on the wider scheme, so I feel like the longer term chart with my count lines up really nicely, pointing towards 6,800 or just below 7,000. And I think that is a minimal target. And just get onto the daily levels. Sorry, actually, just get onto the weekly levels again. If you think, the thing is, if we had a wave three here, then we had, let's say we have a ABC move from here to wave five. This is still really short. We're still nowhere near the C equals A extension here. And even if you think this is a three-wave move from this wave four low, we should still point towards 7,000 region. So I think we haven't topped from a technical perspective and fundamental perspective, but just want to remove this. But we could essentially have, short-term volatility right up towards the new year, ignore the timeline here, and then we could have a bigger correction as the recession comes underway next year or something. And then we finish off with wave five. And that is my expectation. And I think I'm just going to see if I've got the... okay, fine. It's on the other chart. I'm just looking for the chart I had earlier where I had boxes here. Yeah, there you go. So just zooming in here. Okay, unfortunately, I've lost that box, but I think we could have we could touch down here into after FOMC, and then move towards 5,800 into the year end. And in fact, I'm happy to do a live. I'm happy to do a live demonstration here. So I think we could expect something like this. So support being here, and target being here. And because it is a wave five, we could have a ending diagonal. So in a 3-3-3 structure, all it means is that all the impulsive waves have ABC waves up as opposed to the normal five waves up. So I think, so that's my expectation right now. I mean, we could have bottom here and start turning up, but from seasonality perspective, I do think we can touch down here, and that would be something like the 0.786 to 0.618 retrace of this move from August low. So yeah, so that's my expectation for SPY and SP 500. So just moving on to yields then. On Friday, so my honest opinion is that the non-farm payrolls report doesn't warrant a 50 basis point cut from what I understand about the Fed. I'll be very shocked if they do cut 50 basis points. But, but there's every chance that CPI could undershoot, which they did in the previous few months. And we could get this final leg up towards our initial target of 102. But I think the risk reward of holding the trade here is not that much. So I don't mind taking profit around today. But I've already closed the trade. I don't mind taking profit now, or if CPI prints softer and we get more cost pricing, is a good time. Um, and for and same for TLH, I think we're very close to this wave 5 target. And I think we can, most of the trade is done. And after this, we just have to watch out for the 5 waves down for ABC correction to see where it lands for our next, for the retrace. Bitcoin is a very difficult one. It's been very, very choppy. It's actually, the market is not showing its hand right now. Is it, so the wave 4 low is not breached yet. And this area here is a significant support for the loans, right? So this area here essentially holds the opposite way 0.78 retrace of this entire leg up. Breaching this low, and obviously you're going to breach the wave 4 low. We're really staring at something like 41K over here, right? But as long as this bottom hold, and if we can get back up above this B wave, I think we're back to the bullish scenario. The trade setup is still intact. We entered around here. At the time, I thought it was going to be a one-way street, but it's not. But it's still live. I'm just going to leave it up to the stops, essentially. I'm not going to try to overreact or preempt anything. Theoretically, we should get one more test to the downside just to really test this support. The volume up hasn't been that great. The volume down has been pretty intense in the past 2 weeks. So I'll be surprised if it doesn't test. Even if we are having the bullish case and we've bottomed already, we should get a 1-2 here. Yeah, we could push a bit higher for the 5th wave and get 1-2 here. And if you haven't entered, it's still good. I think that area is a good entry if you have a tight stop here. The key is a tight stop. So if you get entry here and get stop out here, that's fine, I think. Even if this bearish case plays, because if we've bottomed, the upside is 78K, and that's really good reward to risk ratio. Market hasn't shown its hand. We just have to wait. It's been very volatile. I think a lot of people have been shaken out of this market, which is why we have a wide stop and a small position size, and cannot emphasize enough. Gold approaching top here, I think it's losing a bit of steam. I'm just expecting a wave 4 retrace. Again, ignore this timeline. I'm just drawing the levels here using the chart for clarity. Silver has been a bit tricky. I did expect a pullback given this wave 1 reached the target. Why it's tricky, because we had an ABC correction, but this made a new low to this day, right? And so that's either a bottom, we'll have to start the count again, or it might not even have finished. And at C equals A, it's really going to test this blue box here. We have a stop loss just under 24, so 28.9. Deliberately so, because silver is a volatile asset. I actually think we might have to test this before we go higher. Also, September is a weak season and the inflation is down, so commodities are also suffering a little bit. So I think we might have near-term low versus versus the upside. But I still think we are trading high overall into 30 as a target. So finally, moving to the Magnificent 7 stocks, we're going to through all of them. But rather quickly, I covered Apple last week. I think we're going to have, so we had Apple release day yesterday, and the market, usually those days, the market sell the news. Apparently people are not that excited about iPhone 16. I think the major challenge for Apple is that they're going to do a staggered rollout and AI. So for the AI component, so the phone might be ready first, and AI will be rolled out. The reason they're doing it is because since Gen AI came out, we had some hardware companies attempting to do AI companions like Rabbit, the green phone, and Humane Pin, which is something you put on a shirt and you can look at the projection on your hand. But they've been really bad. Like the reviews are absolutely brutal. So I think Apple is quite wary on the potential reputational risk this could have. It is a significantly more challenging technology to putting. All the big companies have focused on the software, on the dev, but Apple might be the first one to really use hardware properly to leverage GPT. Um, and it's not a small obstacle. So I do understand that investors are not that happy yet. And also there's going to be regulatory challenge in EU and China. So EU has uh, has essentially privacy laws that makes it tricky for Apple to send up, messaging to GPT or whatever, even anonymously. But I think the EU part can be worked out. China is much trickier because China is a big market share for Apple, and Apple is losing ground. And China has gone into a protectionist mode where government workers cannot use iPhone because they worry that they lose their data to the US. And also, if you're Chinese, you should support Xiaomi or Huawei, and not Samsung or Apple. So, and I think that's going to be a larger trend in terms of geopolitics. And I think it's a losing battle trying to fight that trend. So I think when the iPhone 16 comes out, it's going to have some turbulent month. But if the Apple can really get it right, and no one, the history suggests they do eventually get things right, we can have much further upside from here. And I've got wave three target being 300, which is almost 50% from here. So near-term bearishness and medium-term bullishness. Tesla, extremely volatile in the past month. We got stopped out here. We couldn't catch the trade here, and then also topped out here again. I think we're in an ABC correction now. I think the 5 waves have stopped. This is an expanding diagonal, a leading diagonal for wave 1. So this will be a wave 1 and 2. I think wave 2 would land around here, below 200. And 200 would be a quite good entry against 182 low. And so we potentially have a 1-2 setup here. But we just have to watch, especially if, I think we just have to watch. I think having an entry around here and a stop around here makes sense from risk reward. Robo-taxi event is in October, which is next month. So we could have bearishness going into that. And maybe the sentiment picks up again in October with robo-taxi. I'm just speculating at the moment, but that could be a potential catalyst. Amazon, it's been quite bullish actually. It hasn't really done that much correction with the broader stock market. It's nearly back to the wave 1 high. I mean, there's a chance that we've bottomed here, but given what we know about the wider seasonality, etc., I still favor this being the main path. And also, we haven't breached the wave 1 high here. We haven't really had 5 waves up. So I'm still favoring waiting. I'm long already for disclaimer, but if I wasn't and I'm looking for entry, I'll still wait for entry around 162, targeting 214. Google is a really tough one. It's just falling every day, essentially. Google now doesn't look that expensive relative to peers in terms of PV ratio or the revenue ratio in terms of forward ratios. But it's just fair right now. If you look at where wave A is, and it's quite a shallow pullback for wave B, and now looking at wave C target, and wave C typically has 5 subwaves, I think we are looking at 130 to 135 region as a bottom. And I actually don't mind buying around here. buying around here, and then have this as a stop loss over here, which is the previous wave two low in 2023. Yeah. So previously, Google did a big run from, yeah, okay. Yeah, so in the past year, Google still did pretty well, but I think we can get back to this entry point. And over here, I think Google will be cheap-ish relative to peers as a purchase. So I'm just waiting for wave three at the moment, and I wouldn't trade the wave four upside. NVIDIA, we getting a bounce. I think the 5 waves down can be seen as complete in terms of Fibonacci levels. And it may have topped. We attempted a wave 3, 4, 5 run, but I think the semis may have topped in the near term. And if wave C equals wave A or 1.236 extension, we are looking at anywhere between 75 and 82. We are looking at a bounce right now, but the strength of this bounce really depends on the wider market as well. We might not even get this high. We might not even get this wave to a high here. It might be over here. So I really wouldn't play the long over here. If I were to short, I would probably short around here and try to take profit on this downside for wave 3. Alternative, you can wait for NVIDIA to break this longer term support. I'm just zooming out on where we are. Okay, that didn't help me because I've lost that. I've lost that channel. Oh yeah, over here. Yeah. So we've got this channel going from 2022 October low. Brilliant run up, resistance zone. If it breaks below this channel, and it's pretty bearish from here, so much lower afterwards. Finally, Meta, we nearly got our entry, but still not quite. And I'm not eager to be too aggressive on this. So I'm just going to wait. To be fair, Meta is still still quite close to its all-time high. It's a very bullish stock. I don't think it's done it. I think Meta has room to run. It's a younger company than the other Magnificent Seven as well. Finally, Microsoft. I think we still have room to run on the downside over here. I think some people would hate me for this, but that is still another 15%. So similar to Google, 15% drop. Yeah, which will bring us to the end of this channel. I think that's pretty much it for today's webinar. Does anyone have questions? It could be anything from the charts to the fundamentals or even the slides I did earlier. Just unmute yourself and just ask away. Okay, brilliant. So unfortunately, I'm in the UK, so I can't watch the debate live today. I'm just going to put it back. Yeah, so I can't watch the debate live today, but I'll watch a recap tomorrow and see what happens. But otherwise, have a great evening to you all, and thank you for joining me today. And obviously, if you got any questions, just ping me on Slack. I'm actually getting a lot. Yeah, cool. All right. Thank you.